obviously a quiet end to a noisy month is the way I would put it. And the market essentially held this two-day pop that we got. I see it very much as a kind of sentiment positioning move, this recovery we've had this week, meaning people got way overextended on the bearish side, the negative side, in the very short term, saying that the bond market was sending scary signals, a lot of defensive action, and I think we've reversed some of that. If that dynamic continues, that mean reversion, just because stocks have done so poorly relative to bonds, just because people have gotten so defensive in their positioning, I think there's more to burn off right there. But the volatility index, as Sean Cruz was mentioning, was up today. The natural tendency would have been for that to bleed lower before a three-day weekend. It tells you the market is still on edge, and yes, because we've not gotten that real clearance, that all clear from yields that we can rally freely.
But your point about the fact that we have rallied despite the flat yield curve, does that mean we don't need the rate cut anymore?
No, I don't think that's true at all. I think the rate cut at this point in September, when you're in a 3-week window, it's part of the premise of why the market's doing what it's doing. The question is what comes after that. Is it still going to be characterized as a sort of mid-cycle tweak or a more aggressive easing cycle? That much we don't know.
So this time last week, you and I were here preparing for markets in turmoil. I mean, that was a down more than 600
What was that little look? So, Wilf was on holiday. He wasn't working.
He was on his 2-month vacation. But seriously, there were some developments this week on the China trade front.
Sure.
China said it's not going to retaliate more.
Hinted so, yes.
Talks seem to be going on at a different level, according to President Trump. I mean, how much is the trade situation filtering into sentiment and price action?
I think it makes the entire tape apprehensive, but really, if you think about it, nothing necessarily happened that was so much different than what we thought, except we didn't get another shock and we didn't get a re-escalation. I think when the issue goes quiet for a while, the market can kind of get its footing a little bit better. And again, it's only because I think we overshot. Again, very short term, we overshot in terms of thinking that bond yields were telling us something very scary in the short term.
Tom, you've been comparing President Trump and some of the policy actions he's taken to Bush Sr., is that right?
Well, if you think about it, the last Republican president that raised taxes was George H.W., and unfortunately he saw one term of his presidency, not two. And while our current president, Trump, has stuck to his guns saying that we are going to lower taxes, which they did in 2017, also saying that he was going to renegotiate some of these unfair trade deals, what's happening with China, J.P. Morgan came out with a report that said that if all of these tariffs that go into place, that it would be the equivalent of a $200 billion tax increase to Americans, which wipes out the $165 billion tax decrease that we saw in the end of 2017, plus another $500 out of the average American's pocket. So we're not saying that he's said no taxes and raising taxes, but if it has the exact same effect, tell John and Mary Smith, who live on any town in America that has less money in their pocket, that this isn't a similar thing. It's going to be tough to run again in the next for the next year if we do end up sliding into recession.
Let's get more on the month's biggest movers overall. Bob Pisani's having a look at those here at the stock exchange, and Kate Rogers doing the same with the Nasdaq. But Bob, let's start with you.
The trade that worked this month was very reliable, except for the last few days, was to short economically sensitive sectors, and we're talking, of course, about industrials or semiconductor stocks, and go long more defensive sectors like consumer staples. So just take a look, semiconductors, energy, transport, semiconductors all down on the month. Defensive names like consumer staples and particularly utilities on the new high list almost every day for the month. And this was very reliable right across the board. Investors went for more defensive and sometimes more U.S. oriented, not always, names like Verizon, Coke, Merck, and McDonald's, all up. Remember, the S&P was down slightly for the month overall. And cyclicals were all reliably down mid-single digits to high single digits. So these are the classic ones that are in the Dow Jones Industrial Average, Dow, Caterpillar, Exxon, and 3M. Guys, back to you.
All right, Bob, thank you. We'll head over to the Nasdaq now. Kate Rogers has this month's movers there. Kate.
Hey, Sarah, that's right. Well, we're closing out the week here higher at the Nasdaq, but for the month, we're down just about 4%, breaking a 2-month streak here. Now, the Russell 2000's also down over 5% for the month of August. In terms of some individual movers here, To the downside in August, Ulta was the biggest laggard, down over 30% for the month. Kraft Heinz down over 20%. C-Trip was another loser here, and NetApp, another big name, seeing losses. And then to the upside, some biotechs. Amgen was among the winners. Symantec, Costco, and Pepsi, month to date, all in the NASDAQ 100, seeing gains between 7 and over 10%. Guys, back over to you.
Thanks very much, Kate. Mark, we've got banks down some 9%, the KBW Banks Index for the month overall. That's even after a strong bounce, 4% bounce this past week. Is there still value there despite the bounce this week?
I would say no. I mean, I'd be avoiding the regional banks specifically. I mean, they really can't make money given where the net interest margins are right now, given the yield curve. And that's one of the reasons we're actually avoiding small caps in general, right? I mean, there's a very heavy concentration to regional banks within the small cap index. They also have a very heavy concentration to industrials, which are cyclical. Within small caps, you've got basically a third of the companies aren't making any money, lots of debt. So at this stage of the economic cycle, we'd prefer large caps and we'd be avoiding the regional banks.
Tom, so you run a wealth management company. How would you gauge the sentiment of your clients, how spooked they got from some of the headlines over trade this month and some of the volatility we saw in stocks and bonds?
Sarah, it's a great question. It's hard not to be affected by what's happening, what you hear, some of this, because it's juicy, yield curve inverting. I met with a client yesterday that came in that said she was very nervous about the inversion of the yield curve, and I asked her if she knew what that meant, and she didn't. So I think the news headlines right now, there's a lot of headline risk. But that being said, we're continuing to remind our clients, if you're a long-term investor, because we're not traders, we're long-term investors. Some of our clients, good chance they're going to live 30 years in retirement. We're encouraging them, think long-term. Think about a lot of these things that happen. They're a lot like a kidney stone. They hurt really, really bad, but they don't kill you. And so we're telling them, let's look at fundamentals. And the yield curve inverting, while that's an important indicator of a looming recession, it's only one of many indicators. Look at the LEI, the leading economic indicator index. 10 of the most important economic indicators always goes negative 6 to 11 months prior to recession. And right now it continues to stay positive. And if indeed the yield curve inverting is an indication this time, like it has been in the past, of a coming recession, on average, it takes 25 months to slip into recession, and the market's up 33%. So if you think it's the yield curve inverts, you shut off the lights and you leave the party, if that was the case, you would have left a lot of money on the table. So yes, I think investors are nervous, but we're encouraging them, look at the fundamentals. Fundamentals remain strong, and let's be cautiously optimistic. That being said, with all that being said, we are beginning to tap the brakes on each of our portfolios a little bit moving into September.
Okay.